But that I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap.
In the early days of Warren Buffett's investment journey, he didn't have millions at his disposal. Instead, he worked with a humble capital, yet managed to achieve extraordinary returns that laid the foundation for his future success. How did he do it? Well, it all comes down to his unique approach to investing, focusing on undervalued opportunities that many investors overlooked. In this video, we'll uncover the secrets behind Buffett's success and how he transformed small sums into a vast fortune. We'll explore his methodology for selecting stocks, his criteria for choosing businesses, and the importance of deep research and analysis. Buffett's early investments weren't in the big names everyone was talking about. Instead, he found hidden gems, small unglamorous businesses that were solid in terms of their financial and business models but were undervalued by the market. We'll break down Buffett's key principles for investing with limited funds, from looking for undervalued opportunities and doing thorough homework to being bold but not reckless. So let's dive in. Now let's rewind the clock and dive into the early days of the Oracle of Omaha, Warren Buffett. Picture this, he didn't kick off with bags of cash. It was more like a few bucks and a pocket full of dreams. What's truly mind-blowing is despite his modest capital, Buffett managed to pull off some insane returns that set the stage for his legendary journey. We're talking about turning pocket change into a financial empire. Who knew a small investment could make such a massive impact? So what's the secret sauce, you ask? Well, it's all about the philosophy. Buffett wasn't chasing after flashy stocks or quick wins. No, he was all about undervalued opportunities. He wasn't just bargain hunting, he was on the lookout for hidden gems, quality businesses that had more potential than the market was giving them credit for. Alright, let's talk about Buffett's criteria for picking stocks. Now this isn't some mystical formula, it's more like a common sense approach that makes a whole lot of sense. Buffett's first and foremost rule is to understand the business behind the stock. He once said, "We are looking for a business we can understand." It's not about complex equations, it's about getting the scoop on how a company operates. This means checking out what they sell, understanding their competition, and figuring out what could possibly go wrong over time. So when Buffett talks about picking stocks, he's essentially laying out the blueprint for looking at a business. Sounds simple, right? Now here's where it gets interesting. Buffett wasn't chasing after the popular kids on the block. Nope, he was out there hunting for hidden gems, those little-known companies that were quietly doing their thing in the market shadows. It's like he had a radar for undervalued small businesses. He wasn't interested in the flashy headlines, he was after solid financials and business models. During this phase, Buffett adopted what he called the cigar butt approach. Not literally, of course, it's a term he borrowed from his mentor Benjamin Graham. It's about finding companies that might look beaten down but still have that one good puff left in them. It's a mix of being savvy and patient, waiting for the right moment to grab a bargain. Let's unpack this cigar butt approach a bit more. Buffett described it as trying to find a really kind of pathetic company that's so cheap you get one good free puff out of it. But here's the twist. Buffett moved away from this approach over time. He realized it's not just about grabbing a cheap stock, it's about investing in quality businesses. He wanted to be in businesses that were not just good now, but would be even better 10 years down the line. So, he shifted from the cigar butt approach to focusing on quality, buying into businesses that had a bright future ahead. Alright, let's talk about the first principle straight from the wisdom of the Oracle of Omaha himself, Warren Buffett. Look for undervalued opportunities. It's like going on a treasure hunt in the stock market. Buffett wasn't interested in what everyone else was hyping up. He was on the lookout for diamonds in the rough, companies the market had overlooked. And get this, it's not just about finding cheap stocks, it's about understanding the intrinsic value of a business. It's like figuring out if that stock you're eyeing is on sale or if the market is just undervaluing a hidden gem. Now, Buffett wasn't just casually flipping through financial reports, he was diving deep into the business world. Principle number 2, do your homework. This means no shortcuts. You're not just picking stocks, you're practically becoming a business detective, analyzing business models, crunching numbers from financial statements, and understanding where a company stands in its industry. Buffett was like the Sherlock Holmes of the stock market. It's not about the thrill of buying and selling. It's about knowing the ins and outs of the businesses you're investing in. Here's where it gets interesting. Buffett had this thing about concentrated investing versus diversification. Principle number 3. Be bold but not reckless. Now, most folks will tell you to diversify, spread your eggs into many baskets, right? But not Buffett. He believed in going all in when the stars aligned. It's like putting your money where your research is. But, and it's a big but, he wasn't advocating for throwing caution to the wind. Being bold means having the conviction to back your research with a hefty investment, but it's also about keeping an eye on the risks. Alright, let's take a stroll through Buffett's real-life playbook, starting with the Geico investment. Picture this, young Buffett, still a student under the wing of Benjamin Graham, gets wind that his mentor has a stake in Geico. Now, instead of just nodding and moving on, Buffett's curiosity kicks in. On a Saturday, he heads straight to Geico's headquarters in Washington, D.C., finding the offices closed, but luck favors the bold. He bumps into Lorimer Davidson, Geico's VP, who's working on a Saturday. Hours later, Buffett is knee-deep in insights about Geico's unique business model. Unlike other insurers, Geico sold directly to customers, cutting out the middleman. Buffett sees the potential, and with the confidence of a seasoned investor, he plunges more than half his net worth into Geico. Fast forward and Geico becomes a giant in the auto insurance game. That bold move turned into a financial jackpot, proving that sometimes fortune favors the daring. Now let's talk about Buffett's wild ride with American Express during the infamous salad oil scandal. The market's in chaos, everyone's panicking. And what does Buffett do? Instead of joining the panic party, he decides to throw his own investigation shindig. He hits the streets, visiting restaurants, chatting with people using American Express cards. All hands-on real-world stuff. His analysis? The scandal might be serious, but it hasn't wrecked the core value of American Express. So what does he do next? Bold move. He allocates a whopping 40% of his partnership's assets into American Express stock. Now that's like putting your money where your mouth is. Fast forward again, American Express not only weathers the storm but comes out stronger. Buffett's contrarian approach and bold investment decision not only saved the day but also add another golden feather to his investing cap. Let's talk about the secret sauce that turned Warren Buffett's spare change into a financial empire. Compound growth. It's not some financial jargon, it's the powerhouse of investing. Imagine compound interest as your money's own personal cheerleader, working not just on your initial investment, but on the interest it earns over time. Buffett in his early days didn't just stumble upon this, he harnessed the power of compound growth like a pro. It's the kind of magic that turns a modest investment into a money-making machine. So if you've been wondering how small amounts can lead to significant wealth, this is where the magic happens. Now, let's break it down with a little scenario. You've got $10,000 burning a hole in your pocket. It's not exactly a fortune, right? But hang on, you do your research, pick a stock that's like a hidden gem in the market, undervalued and ready to shine. Now let's say this investment grows at a respectable 20% annually. Fast forward a decade and boom! That $10,000 didn't just grow, it multiplied into over $61,000. Each year, your gains are reinvested, creating a snowball effect that turns your small investment into a financial snowstorm. As we wrap up, remember, whether you're working with $1,000, $10,000, or any other amount, the principles remain the same. It's not about the size of your initial investment, it's about how smartly you invested. If you enjoyed this video guys, make sure to subscribe to the channel, like the video, and watch this one as well.